Hi, this is Jason, Chief Technical Analyst with ToroAlerts with your weekly market recap for the week of June 27th. Markets are down this week, including crypto, so let's dive into the charts and see what we're seeing here. Starting out with the S&P 500, we did finish up a bit to end the week on Friday, but we are coming up against this down channel that we've been watching, and it's held as resistance a couple of times already, and we're coming up on it for about a third time. So it'll be interesting to see as we open up the week after the holiday weekend whether or not we can clear that resistance line and actually head to the upside a bit. But I think whether or not we hold that as resistance or not, either way, I think it's pretty obvious that we're still in a down market and heading lower at some point. And so let's take a look at a few of some potential bottoms, as there's been a lot of conversation about how far we can go in the markets. And so taking a look at a variety of different technical indicators, I'm thinking there's a decent chance that we're looking at a bottom on the S&P 500 between 305 and 325. 305 is actually lines up with a 1.61 Fibonacci retracement that lines up really nicely as well with an anchored VWAP position. And so it looks to me like if we were to try to pick a bottom, that we probably have another 15 to 20% of downside left in the S&P 500 before we do find that ultimate bottom and start to hopefully head back up to the upside. So that's kind of what we're looking at medium term. I think there's a good chance it could take most of the summer to get there, but we'll be keeping an eye on that every week as we always do, and revise that if we see anything changing. But for now, I think 305 to 325 looks like a pretty solid, high probable potential bottom on the S&P 500. And then taking a look at the NASDAQ, we're actually just up against Fibonacci extension that's looks like is acting as resistance right now at the 282.20 level, and we'll see if that ultimately acts as resistance and if it rolls over starting the week next week. But either way, it looks like to me on the NASDAQ heading lower at some point, and when we do potentially carve out a bottom, it's possible we could be looking at a bottom in the NASDAQ around 225 to say about 237, 238. I think that's a range I'm kind of looking at on the triple Qs for some potential support from this sell-off. Taking a look at the Dow Jones Industrial Averages. On the Dow Jones Industrial Average, we're also up against a Fibonacci extension level, acting as resistance at 311.60. So we'll see if that ultimately holds and if we head lower from there. But as far as some potential bottom, sometime likely into the summer, I'd be looking at something around 255 to about 267 on the DIA for potential bottom in the Dow Jones Industrial Averages. Likely headed lower on all three of these still until we can carve out a bottom and see some capitulation. Taking a look at the Dow Jones Transportation Index, we have broke down a few weeks back, talked about this 14,373 level as it was holding pretty nicely for the Dow Jones Transports, and then when that did fail, that was also when the market started selling off a little further. Now we're kind of hanging out between, it looks like the 100 and 150 week moving averages, still above the 200 week moving average and our anchored VWAP from the COVID lows, but I think we're still heading lower on the transports as well, likely looking for probably a bottom on the transports, maybe at the highs before the COVID crash, right around the 11,350 level. And then jumping over to Russell 3000 chart, we've been bouncing around this center channel lane here, this yellow line, and came up against it, acted as resistance, and then it sold off a bit, closed down lower on the week, but higher than the previous week, and sitting right around the 150 week moving average. At some point I'm expecting will likely drop below this 200 week moving average and then head down to this bottom channel, which represents about another 15% or so of downside on the Russell 3000. Take a look at the Russell 1000, our large caps, hanging out just above the 150 week moving average on this one. Kind of some sideways choppy action for the last couple of weeks on the large caps. Likely headed lower on this one as well, though. We'll be looking for this, how it acts off this 200 week moving average, and see if that ultimately holds a support, which is right around the 195, 196 level on the IWB. And then taking a look at our Russell 2000, our small caps. Could be a nice shorting opportunity on this one. I like this 173.55 level as a really key support and resistance level. It acted as support when we were above it. for a while, and now it is trying to kind of get back above this level. So I kind of want to see the price action develop going into the next week. But if we do stay below that 173.55 and head lower, could be a nice short setup on shorting the small caps. We're heading below the 173.55 level. And then taking a look at our growth versus value, we've had a few weeks where growth really outperformed value, which has been not the overall trend since about November of last year. But we did reverse that this week up against a potential resistance line about 1.53 on the ratio chart, and it did fall down to about the 200-week moving average on that. So we'll see where it goes from this week. My guess would be probably lower, and the value likely continues to outperform in the markets. And then taking a look at our sector analysis, this is the sectors that we've been tracking over the last 10 trading days, so the last 2 weeks. Take a look at the sectors that have really outperformed and underperformed, and so some of our leaders we've talked about biotech the last couple of weeks, and biotech continues to be a strong one, up almost 20% in the last couple of weeks, so some real upside momentum in the biotech space, so that might be a place to look at for some trading opportunities. We also saw ARC Innovation bounce back pretty nicely with about 11.5%. Cloud computing is up about 11.5% as well. So the utility sector would be real strong. That's definitely a defensive sector, but that's up almost 10% on the last couple of weeks. We saw home builders with a nice move, 9% up on the week. Solar still looking pretty decent at 9% almost. Healthcare, real estate, 7 and 8% as well. Also in other real estate ETFs, clean energy. So we've kind of been seeing a trend here with clean energy, solar, home builders starting to work, some of the utilities and healthcare defensive sectors. So we've definitely started to see certain sectors over the last probably 4, 5, 6 weeks really start to show some leadership. So we'll keep an eye on those to see if those continue. And then looking at some of our weakest sectors, natural gas is the worst performing sector of the last couple of weeks, down almost 24%. Natural gas is one of the best places to trade to the upside for most of this year, but that's definitely changed over the last 2, 3, 4 weeks or so. And so something to keep an eye on if this is just a correction after a massive run before we head to the upside again, or is this telling us that natural gas and potentially energy more broadly, if maybe that trade is either slowing down significantly or potentially over. So we'll keep an eye on that. The second worst leader is the XOP, the oil and gas exploration ETF, and so that's down 13%. We also saw a huge sell-off in silver, which was a little unexpected, drop below the 200-week or 200-day moving average on that one, and so that was down almost 10%. Gold also really underperforming, down the gold miners down 8.5%. Other lagging sectors, metals and mining, steel, the energy sector broadly, and semiconductors, and so those are some of the worst performing on the last couple of weeks. And then jumping over to the U.S. oil chart, we are still looking somewhat bullish, but also we've kind of chopped around and sold off a little bit in the oil prices. Maybe good news for the gas pump potentially for a little bit of relief, but on the energy trade, things are looking a little bit more dicey these days. And so as long as we're above $100 a barrel on the U.S. oil barrels, I think there's still some optimism to be had for potentially just this being a short-term correction before we head higher on oil prices. I think the supply-demand imbalance is still very much an issue in the oil space. But we've also seen a pretty significant cooling off and really a big correction in most energy stocks over the last few weeks. And so something to be keeping an eye on to see if we actually can move maybe one more leg higher on this thing for another nice energy trade setup. But for right now, I guess it's maybe slightly bullish to neutral on oil until we kind of see some further developments on that. And then we jump over to the commodity space, the CRB Index. We talked about it likely when it started correcting, coming back to the center channel. Well, we've hit the center channel now this last week on our weekly candlestick. So next week will be really interesting to see where we go from here. Does it act as support, and then we see commodities head higher? That could be bullish, potentially a bullish signal for oil, but also for other commodities if we see that happen. But if we see this actually go down back into this lower channel that we've been kind of trading up to the upside for quite some time, but we had a pretty clear break up into this second channel here, and now we've been up here for some time. And so if we get back down to this lower channel, that would look a little bit bearish, I think, for commodities and potentially the energy sector. So we'll be keeping an eye on that one. It could be giving us a good signal here going forward. And then when we take a look at our consumer discretionary versus consumer staples, interesting thing we're seeing here, we actually did drop slightly below this trend line support here, but we did close slightly above it for the week. But this is something we'll be keeping an eye on, because this is our basically kind of a risk on risk off chart, because when we've got consumer discretionary is more of a risk on sector, consumer staples is more of a defensive sector. And so anytime the defensive sectors like consumer staples are significantly outperforming discretionary, that's typically a really good risk off signal for us. And as we can see from this chart, we've been really heading straight down to the right really since I think it was November of last year, and so that's been a pretty strong warning signal for us. Well, now we're all the way down to this 0.65 level, which we've only dropped below 2 other times, and that was during the financial crisis and the COVID crash. And so if we see a close and we see it hold below that 0.65 ratio line, I think that's just another warning signal for the markets abroad that we likely have some more pain ahead, and this could be a bit more of a correction in front of us, which is I think what we're expecting. And then when we jump over to the all-world US ex-US index, the VEU, so this is the global stock market minus the United States, we can see over the last 3 weeks or so, these are weekly candlesticks, it's just been kind of some choppy sideways action on this one. So we'll just be keeping an eye on that one. But when we look at it on a relative basis, we talked about a few weeks ago how we actually started seeing some relative outperformance in emerging markets, but that looks like that was maybe short-lived, and we're already starting to roll over. 2 weeks ago we had a pretty big move on a relative basis to the downside, and then this last week didn't do much of anything, just kind of hung out about where we closed the previous week. So on a relative basis, the global markets aren't looking like they're any better than the US at this point. And then when we take a look at our high yield corporate bond ETF, we've been calling out the 75.11 level as a really key level to watch for more signs of struggle in the market, and we did drop down below that 3 weeks ago. We tried to get back above it last week and failed, and then this last week we dropped down back to it looks like actually closed at the new low on this downward cycle that we're in right now. So definitely not a bullish sign at all with this. And then when we look at on relative terms, taking a look at the corporate bonds divided by the IEF, which is our traditional bonds, we talked about how if we saw a clear break below that 0.73 line, which we clearly did on the week, that could be a warning signal for the next leg down in the markets. And so we'll see if that ends up being the case going into next week after the holiday. And then when we talked about a little bit in our sector update, gold and silver really underperforming on the week. So gold's down on the week, sitting at about 168 an ounce, and then silver kind of expected that might have held on the 200-week moving average, but it didn't, and it closed down a little bit lower further, and so we closed the week at about 1831 on silver. We are sitting at still above a pretty key support level. If we get below 1775 on silver, I think there'd be maybe some concerns that we might continue to see silver sell off a little bit lower. But otherwise, if we hold that actually could be a nice Fibonacci retracement of about 1.618, and just kind of normal market price action, and then likely we could see silver head higher from there. So we'll be keeping an eye out on that one. And then on the dollar, the DXY, we did see for the last few weeks kind of some choppy price action, trading in between this 104, 105 range, but we did close the week above that 105 level. And so if we can hold that going into next week, there's a good chance we're going to see the DXY head even higher. Those next couple levels that we're looking at is about 107.70 and then 110.40 approximately on the next two targets to the upside on the dollar. And then when we're taking a look at our tips divided by IEF, so this gives us a nice kind of inflation expectation chart. And we definitely saw a pretty big change this week. We had a very strong convincing close below the 50-week moving average. That's only happened once since we've had this kind of structural change in interest rates going up. And we've also seen, as we're going to see in a minute here, all the major interest rates continue to head lower as well. So with seeing that the rates go lower, as well as this chart having a pretty significant trend change. Unless we see a big whipsaw next week where this corrects back to the upside, this could be giving us a signal that potentially, even though there's still lots of conversations around more rate hikes, that the bond market might be pricing that the top is in rates. And so if you're a bond investor looking for some opportunities to get into buying some bonds like the TLT or the IEF, we could be seeing a trend change here that might be signaling opportunity, but we got to be careful because we've seen a couple others like that where it looked like we thought that the bonds were potentially putting a bottom in, and then they weren't. It was a bit of a fake out. However, this is one where it's been a little bit more supported with some different, better data and evidence. So we'll definitely be keeping a close eye on this. Not a big bond trader, but there's not a lot to trade out there in the markets right now. So if we see a clear opportunity to potentially put some call options in on some TLTs or IEF, definitely going to be keeping an eye on that here in the coming weeks. Taking a look at the 2-year, finished the week about 2.84%. 10-year, we finished the week down at about 2.88%. Also did hit this 40-year trend line, which we've been watching very closely. We sort of didn't expect it that it would break above that trend line, but it did. And then we've now retested this trend line twice from the top side of it. So if we can see a clear drop in the 10-year below and get below this trend line again, I think that would just be another signal that potentially there could be some bond trade setups transpiring here. And then when we look at our 30-year, we're at about 3.11%, closing out the week on the 30-year. And then taking a look at our yield curve, we are hanging at 0.05, so just above the zero line. A lot of people think we're going to get inverted again. I think I would tend to agree with that. So the way this chart's setting up and the way it looks, probably isn't going to take more than, unless we see a trend line break here, good chance that in the next 2, 3, 4 weeks we'll likely see some sort of resolution. We'll either see it drop below that zero line or some sort of trend break, and maybe we move to the upside, but we'll keep a close eye on that. And then we take a look at our VIX. If we are going to see a sell-off to the next leg to the downside, likely going to see the VIX spike up above 30 again. So far that hasn't happened. We're sitting at about 26.7 on the VIX at the end of the week. And so if the VIX does stay below 30, then maybe we do have a little bit of either choppy sideways action or maybe even a little bit of a bear market rally. But if we do get that VIX above 30 again, that's definitely going to be one of the warning signals I'll be looking at as well for potentially the next leg down. And then when we look at our put-call ratio, we're actually sitting at a fairly normalized levels. Anything above 1 is considered elevated put buying protection. We're close to there. We're just below that, 0.967, but we are below the 1 line currently, so it's considered in fairly normal ranges of put buying protection at the moment. We'll go ahead and close out the week with Bitcoin and take a look at the Bitcoin chart. Not a lot of trade opportunities that we're seeing in the crypto space. Things are definitely selling off in crypto as well. We have seen a drop below the 20,000 with a couple of days candlesticks closed below that level now. It looks like it's trying really hard to hang above the previous couple candlestick closed lows, which were sitting right around 19,000. So we'll see if that holds. My guess is it may hold for a little bit, but at some point it's likely is going to fail, and I think we do head lower. I do have a few ideas on some potential bottoms in the Bitcoin space. I'm looking at a anchored VWAP that from the previous halving cycle, so not this halving that we've been through, but the one previously. And if we take the low from that last halving cycle, put an anchored VWAP on it, that sends the price signal up here to about just below 11,700 currently. Now this thing moves all the time, so that doesn't mean that is necessarily the fixed bottom, but I really think there's a decent chance that that could potentially be a bottom, or if not the bottom, a pretty close to the bottom, and a really good buying opportunity in Bitcoin. So I'm really looking to watch for that level really closely. If I see price action get down to about this 11,700, maybe it's 12,000 once we get there, but somewhere in that kind of 11.5, 12K range, I'm going to be a pretty aggressive buyer of Bitcoin, especially if I see the price action kind of hold that as a floor. And even if I'm wrong and it goes a little lower, I really couldn't expect to get much lower than say 8 or 10,000 at the worst case. And so if you've got a long enough time horizon, if you make the bet at 11, 12,000 and you're slightly wrong, but it's just a little bit lower, you'll be fine in the long run. And I'm definitely looking to make some long-term Bitcoin acquisitions once we get down to these prices, because it likely will be a really great buying opportunity that we may never see again. And so trying to find those tactical bottoms and really take advantage of them is going to be real important coming up here, likely into the summer or early fall, I think. So thanks for tuning in this week. We'll see you next time. Make sure to download the ToroAlerts app on the App Store. We've got one for stocks and one for crypto. And make sure to like and share.